We estimate credit loss expense. It's an income statement figure, and the most commonly used method is this balance sheet approach. And under the balance sheet approach, the ending balance of the allowance for credit losses, that's determined first, and it's determined as a percentage of the ending accounts receivable. We use a balance sheet account known as accounts receivable to determine another balance sheet account, which is the allowance for credit losses. So we first determine the ending balance of the allowance for credit losses, a contra-asset, a balance sheet account, and then we back into the income statement figure known as credit loss expense. And that means credit loss expense is not going to be determined directly, but instead credit loss expense is going to be an adjustment made to the allowance account from its beginning to its ending balance. So let's look at the balance sheet approach to estimating credit loss expense. If the exam asks for the balance sheet approach, we're going to take a percentage of ending accounts receivable, and that becomes the ending allowance balance. So they'll tell you that the beginning allowance for credit losses is $1,000, and the ending accounts receivable is $200,000. Then the exam will provide the estimate based on experience of maybe 5%, and you have to determine that the ending allowance balance is therefore $10,000, or 5% of the ending accounts receivable balance. So under this balance sheet approach, we used one balance sheet account, accounts receivable, to determine another balance sheet account, allowance for credit losses, which is now determined to be $10,000. Is that a $10,000 credit or a $10,000 debit? Well, what kind of an account is allowance for credit losses? It's a contra-asset. Contra-assets have a normal credit balance. So this $10,000 ending balance is a credit balance. Let's make a T account. They told us the beginning balance of the allowance is $1,000. We put it on the credit side because it has a normal credit balance. We're working with a contra-asset, allowance for credit losses. Normal credit balance, beginning of $1,000, and the ending balance we just calculated, 5% of ending accounts receivable, which is $200,000. So the ending allowance is $10,000. We had the beginning balance, now we have the ending balance. What's the adjustment needed to go from the beginning balance to the ending balance? Turns out it's $9,000. Well, that $9,000 will show up as a credit to the allowance for credit losses, just like here, and a corresponding debit to what account? Credit loss expense. So we got our credit loss expense now, $9,000, but we didn't calculate it directly. We sort of had to back into it by first determining the ending balance of the allowance for credit losses, and then figuring out what's needed to adjust the beginning allowance to the ending allowance. And it turns out that the increase in the allowance is our credit loss expense. And the only way we were going to get the credit loss expense of $9,000 is we needed the beginning and the ending balance in the allowance for credit losses. Could the credit loss expense be $10,000? No, only if the beginning balance of the allowance were zero. That's the only way that the credit loss expense could be $10,000. If this were the first year and there was no balance in the beginning for the allowance for credit losses, then the credit loss expense could have been $10,000. But if there's a beginning balance, you've got to enter it first and then calculate the ending balance, which the exam will give you the percentage and the receivable balance, and that's how we got the $10,000 required ending balance for the allowance. And that adjustment to bring the allowance account from its beginning balance to its ending balance will be our credit loss expense. All right, here's the way the question is going to look on the exam. It's going to say, what amount of credit loss expense should Irvine Corp report at December 31st, year 2 using the balance sheet approach? Irvine Corp's allowance for credit losses had a credit balance of $11,000 on December 31st, year 1. Okay, that's the ending balance for year 1, beginning balance for year 2. So make a T account for allowance for credit losses, and on the right side put the beginning balance of $11,000. They'll give us sales for year 2 and sales returns, but we don't need that. because we're using a balance sheet approach, not an income statement approach. So we don't care about these income statement accounts like sales and sales returns. How about this though? Accounts receivable were $500,000 on December 31st, year 2, before a 10% estimate for required credit losses. Okay, now we're getting somewhere. We're going to take 10% of 500,000 accounts receivable, and that's going to be our ending balance of the allowance for credit losses account. So that means $50,000 you got to put in your T account as the ending balance for the allowance for credit losses. Do that now. So you got 11,000 beginning balance, you got 50,000 ending balance. How do you get from 11,000 to 50,000? You need an adjustment of 39,000 credit to the allowance for credit losses. And that same 39,000 is your debit to an account called credit loss expense. So notice we don't determine credit loss expense directly. Instead, it becomes the adjustment going from your beginning balance to your ending balance of allowance for credit losses. And that happens to be choice D. Note under the balance sheet approach, credit loss expense is not determined directly, but reflects the adjustment of the allowance from its beginning to its ending balance. The information given on sales and sales returns, purely a distractor. Under the balance sheet approach, we use one balance sheet account, accounts receivable, to determine another balance sheet account, the allowance for credit losses. And then we back into the income statement figure known as credit loss expense. Credit loss expense is an income statement account. Allowance for credit losses is what kind of an account? It's a contra-asset. So it's a balance sheet account. So back to our T account, we said that the 11,000 beginning balance, the 50,000 ending balance resulted in an adjustment needed for 39,000 credit. And it was easier because we didn't have any of these, any write-offs. There were no write-offs of uncollectibles. But what if there are write-offs? How would that have impacted the ending balance of the allowance for credit losses, and how would it have changed the credit loss expense? And for answers to those questions and more, get yourself on I-75 with me, Darius Clark, and be home soon. Because the right teacher makes all the difference.